Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. In this episode of the Australian Investors Podcast, I speak with Emanuel Datt of Datt Capital. Emanuel provides us with 3 ASX stock ideas and a concise thesis to match. But before he pitches his ideas, Emanuel takes us through his current thinking on the COVID-19 recovery, impacts on the various asset classes for which he invests in, and the ways to position for different versions of a recovery. I hope you enjoy this episode with Emanuel Datt of Datt Capital. Emanuel, welcome to this episode of the Australian Investors Podcast, mate. It's good to have you back on the program.
Thanks, Owen. Thanks for having us.
It's obviously a little bit different this time around with isolation measures and what have you. So we're trying to record this via Zoom. Hopefully it goes all right. I think it will, because there's a lot of good stuff in this episode that we want to get to. We're going to provide a bit of an overview of what we've seen so far, perhaps the different, the alternative, I guess, recovery narratives that we could see, how to play those, and then finish off with some stock ideas, which will be a lot of fun. So it's a jam-packed episode. I just want to make one thing clear, and I think you're on board with this, is that when we talk about stocks, obviously it's a pretty uncertain environment. So this is kind of us, just two investors talking about investing. If you're listening to this at home, please go away, do your own research. Don't make an investment decision based purely on what you see or hear in this episode. That said, Emanuel, why don't you just give us a quick rundown of Datt Capital, who you are, what you do, the types of investors that you're looking to attract to the fund?
Yeah, so thanks, Owen. So as many of you may know, I'm the principal of Datt Capital, and we run a wholesale fund. So our investors are high net worth, families and institutions. So effectively, we are a little bit different from the conventional equity style fund in the sense that we invest in a multi-asset manner.
Yeah.
So we invest in fixed income, equity, and the like.
Yeah, I noticed in your most recent monthly update that you also have some, is it commercial debt in the portfolio?
Yes. So that we invest in private debt deals or private credit deals, as some call it. And that is just effectively loans with direct security over real assets, real property. And so you can think of that asset class as being like unlisted fixed income, which it pretty much is.
Yeah, right. So and because you're based here in Melbourne, like I am, a lot of it's based in and around Melbourne, right?
Correct. So we restrict ourselves to deals that are only in the 2 main metropolitan areas, so Sydney and Melbourne.
Okay.
And we feel we invest in that manner because it assists with risk mitigation from our perspective, in the sense that Melbourne and Sydney are the only 2 cities in Australia that really attract the global investor or global capital. You'll always find a buyer, in the case of a distressed situation.
Yeah, for sure. It's an interesting conversation we're going to have, because although you and I think the same way in certain respects, we also go about our investing quite differently, and you have experience in many different asset classes than I do. So I'm hoping to pick your brain on what we've seen recently with regards to coronavirus, isolation measures, the impact on retail, on all the different asset classes that you, engage with. Can you take us through, just to set the scene for what we're about to talk to next, just what you're seeing in terms of maybe different asset classes, so just so you could bucket it however you like, and then maybe after that we'll dive into kind of what happens next.
So I guess in the coronavirus impact, I think it's been probably the most substantial impact that we've ever seen, inclusive of times during the World War. Effectively, government actions have been unprecedented and in many ways unpredictable by this sort of response was very hard to predict. State borders, for example, have never been on lockdown at any time in Australia's history, from my understanding. And, so it's a very uncertain times in terms of the government response that we've lived through and experienced the past few weeks. We think that the government response has been appropriate to date, just in the sense that, there was so little information about the actual coronavirus itself, in the early stages. But now, we're optimistic the spread is being contained. New cases continue to trend down. But now that we have some hard data and, the situation locally appears to be under control, we sort of think that a de-escalation in the lockdown situation would be prudent, given the broader effects on society that the lockdown would be having.
So just
especially on...
Just to jump in on that, Emanuel, when you say it might be prudent, are you saying that obviously we're not going to go straight back to no isolation whatsoever, but are you what in a reasonable expectation, I guess, and sense of the word, where would you see us in, say, a month from today as a...
Well, I think social distancing is here to stay for the moment, but I think that awareness of the spread of pathogens has been ingrained in us all, not by choice. I suspect that in the early stages of the so-called lockdown is that social distancing was encouraged, and there were various stages in escalation, and various industries that could not operate according to the level of lockdown, you could call it. So I guess in the sense of de-escalation, I sort of expect that life could be more or less normal, except for those social distancing measures that we're now getting used to. I could imagine those could be in place for a bit longer. Things like schools and kindergartens and the like, we hope will be opened up sooner than later.
Yeah, I guess one thing is that we have two extremes. We have those as investors, as we look at this, we're looking at, on one extreme, we've got, events businesses and businesses that attract crowds to drive revenue. And then the other side, we have businesses that are purely online and have adapted quite well. And there's this broad spectrum in between. So I think what you're getting, it's kind of like we'll slowly just creep this outwards. Maybe in a month from today, where it's less isolation than it is today. One thing you and I spoke about off air was the difference between demand side impacts and supply side impacts. So perhaps you can flesh that out for the listeners and just kind of explain what you mean there, and then some of the challenges or I guess strengths of those two types of thinking.
In terms of demand side impacts, an analogy I can give you is the retail industry. With shopping centres basically shut down, except for grocery parts of the shopping centres are probably still open. But in that sort of sense, all the discretionary retail shops have largely closed due to government regulations, but also due to lack of demand from shoppers. If someone doesn't have a job or for the moment, then they're going to be thinking about conserving cash and trying to sort of understand how to support themselves. So that means no sort of surplus or non-essential spending. So when I say demand side, that's effectively in this case from the consumer side. But conversely, the supply of these discretionary goods has also fallen in a sense, in the distribution sense, I should say, because that's sort of been shifting online. There are online outlets, so there are ways to work around each particular situation in most instances. Yeah.
At the beginning of the year, we heard some ASX listed companies and global companies as well point to supply side challenges, mainly because they were impacted in China and they had warehouses or manufacturing in the region. So that was indirectly impacting our investments and us as consumers. But now we've kind of,
Mm-hmm.
it's been brought to the fore, this demand side challenge that we have here in Australia and globally. So I think we're now dealing with both of those. But at the same time, while we're dealing with the demand side issues here, we're still seeing, I guess we're seeing a loosening of the supply side challenges in China. So in some senses, the retailers could almost be ready to pick up the slack of any demand that comes back to the market because they've got the supply side sorted. Do you think that's reasonable to think that way?
Yeah, I think so. An example I can probably give you is, the construction industry is still open for business and busier than ever, apparently. In January, we're hearing about issues, in the supply chain itself, the construction, material supply chain. A large portion comes from China, but, China was shut down. So local contractors were getting through the local stock or whatever stockpiles they had. But we hear that's not an issue in any way anymore. And that sort of brings me to another point that, as the lockdown in its current state is, the longer the lockdown goes, I think the more and more people will start questioning which industries are essential and which are non-essential. For instance, I've been reading accounts of health professionals working in the private hospital system that are being laid off or, just effectively having their hours cut. So it makes you sort of think what is essential and what's not essential. If this is a true, potential health emergency, and why the private hospitals suffering like this. It's just obviously one small data point, but it definitely sort of makes you think that what makes particular industries more important than others. I
think that's an interesting way to think about it in terms of supply side, demand side for every business, because you obviously do have those challenges regardless whether it's an online business or. So I think investors applying that lens can definitely, I guess, use that to compartmentalize their process and their research. And we'll get to some interesting businesses that you've identified at the back end of the call. But another thing you did is and we spoke about, we've exchanged a few emails over this, is the differences between, I guess, the scenarios that play out from here. And I guess there's this normalization, this, rapid, I guess, recovery back to a normal, quote unquote, lifestyle and consumer. But then there's another one, which is, I guess, this more prolonged, drawn out recovery. That's how you've kind of broken it down, or we've kind of talked about it. Maybe we can take them one by one. If we assume that Australia does move back to a normalized society, you could say quicker than expected, what are some of the ways that we could be playing that?
I guess you have to sort of look at it, in terms of the market context. One thing that we noticed, and it would have been, I guess, quite evident to anyone, which sectors would be hit first, with the government lockdown. Things like oil demand, which, in a normal society, you'd expect demand to be quite inelastic. And inelastic means that effectively we'd expect the demand volatility or to be quite low in terms of change. But, we've seen such a large shock in oil demand that's just been unprecedented, because effectively the whole world has been locked down for at various stages, and that's sort of led to a reduction in oil demand, which has affected the price. Then again, obviously the retail sector and the financial sector, due to fears of insolvency concerns. But all these sectors have been affected the most in terms of equity sort of re-rating to the downside. But, conversely, if we're expecting societies to normalize in time, what that time frame is, we cannot tell. But these are the sort of sectors that would probably be of interest. If your hypothesis is society will be back to, back up and running, in terms of free movement of people and the like, then these three sectors would probably be interesting for any investor out there to look at. But
sorry, I didn't mean to cut you off, but I was just saying that. So we've got we've got oil, we've got financials, we've got retail. If we think about those in the short term? Are there any things, like any factors or I guess variables that you would consider to make something investment grade versus non-investment grade? And what I'm getting at here is kind of like, would you be looking at, I guess, capital structure? Would you be identifying weaknesses on the balance sheet first and foremost?
Yes, absolutely. You obviously want to hedge your bets in the sense that whatever you're investing in, I think you want to make sure that the company could survive. Should we still be should an extended lockdown period eventuate? You I guess want to be sure that whatever you're investing in will survive the next 6 months or 12 months. With a much lower level of business than conventionally experienced. So I think that's probably a nice simple way of looking at it. And also another heuristic of sorts would be to stick to sort of the largest market cap companies, just because that they, this is a generalization again, that they would have the most solid or be most attractive to any acquirers, and can be recapitalized fairly easily. So every situation is different. So but those are two sort of guidelines that I suggest might be appropriate.
Yeah, and I think one thing for me here is I agree with you on this, is that maybe we'll see this kind of reversion to the mean if we get this normalization quicker than expected. And so you still want to be mindful of your downside, absolutely, but it could be, when we say normalization, I think one of the things that we talk about or we think about in these types of situations, and I'm interested to hear your thoughts on this, is when we say normalization, quote unquote, it might not necessarily be the same. As you said, it could be a year of reduced business. It could be longer for some of these retailers, right? Because, like, for example, just yesterday, I bought my wife her birthday presents online because there was no alternative. And had it been the case, I might have walked down to the shopping center or what have you to do that business. And this could usher in a new wave of consumer purchasing, couldn't it?
Yeah, absolutely. I think that for better or worse, this will sort of change our lifestyle to a degree. For example, given that so many people are working and communicating remotely, you sort of wonder about knock-on effects of commercial office spaces, for example. Will people sort of adapt to working at home, or will they still want that sort of more social element, or that enjoyment of mingling with co-workers and other people? I think that there will be knock-on effects, but what they are, that's still to be seen. It could be a total opposite. It could totally go back to normal, and it could be just it's still uncertain. Yeah.
I guess from your perspective too, you think about this a lot more because you have the unlisted side of things as well as the listed side. So, you're not looking just at retailers, for example, you're also looking at the commercial properties and whatnot. The other alternative, I guess, is that we do go into a more protracted, drawn out recovery, you could call it. And I guess, again, this is at one end of the extreme, but you've identified strategies or some sectors that people could be focusing on to benefit as well in that type of environment. So perhaps you can just flesh those out for us.
If we are in an extended lockdown scenario, we would think that the best place to be would be in real asset classes, or real assets, I should say. Things like agriculture, precious metals, cash, unlevered property in some instances. These are the sort of asset classes that we would want to be in. And, part of our thinking is that these sort of assets, they cater to the very basic needs of human beings. And, effectively, should we still have, monetary and fiscal further down the road, these are assets that will always hold their value irrespective of what happens out there.
How about commodities themselves? So we look at gold, we look at things like silver, platinum, those types of things. How do you see those performing in such an environment?
I think they would perform quite well. It's obviously hard to say or provide, a range of upside or potential downside, because so much of, the precious metal commodities prices, I feel, is driven by sentiment. So, but, I'd probably say that a handy little heuristic that we use, trust in government, basically correlates with the metal price or the lack of trust in government. So, people don't trust the government, they're going to be buying physical gold and silver. Whereas if there is a lot of trust in government, then people will generally, be happy to keep cash in the bank or, in stocks or whatever the other, investable asset classes are. And that typically comes down to, the fact that precious metals are not interest bearing in any way. You're not getting, a coupon from them. So they are very, very defensive in nature from our perspective. But, there is a cost, an opportunity cost to hold them.
And speaking of opportunity cost, we've talked about this before. We've said, maybe cash, going all to cash now. We're seeing a lot of investors, or at least probably say a month ago, started to push significant amounts of money into cash. You mentioned trust in the government. We've got the financial claims scheme here in Australia where deposit guarantee effectively $250,000 per ADI. Is that the right move? Like, I know this is, every case varies, but it's a high level thing. Is that the right move right now, do you think?
Well, it really depends. In terms of holding cash, as you say, the government guarantee is restricted to $250,000 per authorised deposit taking institute. I think for any investor, it sort of makes sense just to spread your exposure if you are sitting on cash. I think that if you have questions about the Australian banking system itself, then I think the question would be, where do you hold the cash, or which institute is safe? But I guess it's a very tough question because if you're assuming that an Australian major bank is going to fail, then it really raises questions about the Australian financial system itself. And in my way of thinking, you wouldn't really want to be in cash. If that was the case, you'd want to be in hard assets, hard real assets, which you in that sense you're not at risk of 100% loss. That may be the case if you sit cash in a failed institute.
I guess one of the things that we can think about when we talk about the range of outcomes, we know that this is possible, that's possible, but we try and think, I guess, probabilistically. And one of the best ways I think to get to the bottom of like how we think about the likelihood of these possibilities is just to discuss how you're positioned for this. So, you don't need to go into specifics right now, but how are you thinking about this? I'm guessing you haven't gone all to cash or anything like that recently. So perhaps, just maybe you can comment on some of the things you've done in the last month.
Throughout March, we were strategically placing ourselves. We were sort of selling a few holdings or reducing some holdings here and there. I think that was more because we wanted to have the cash on hand, given the environment. Having a decent cash weighting buys you optionality, and that was sort of our the sort of train of thought or the direction which we were or the position we were wanting to be in.
So were you fully invested?
So yeah, we have. No, we weren't. I think we're holding about 10% cash going into March or thereabout, and we finished March at about 20%, at a 20% cash weighting or thereabouts. But since then we have been sort of dipping our toes into the market, into some particular opportunities that I could talk about now.
Yeah, that'd be great.
One really attractive opportunity we found was in a real estate investment trust called 360 Capital, our real estate investment trust. The ticker on that is TOT. So basically, this is a diversified real estate fund that invests across the capital structure. And its core business is providing commercial real estate debt developers directly. And so this is an asset class that we're sort of intimately familiar with, and we've actually had dealings with 360 Capital, as principals ourselves in the past.
Okay.
So we're quite well acquainted their sort of, and the way they structure the deals and whatnot. But also, they've also got other smaller sort of portions of assets. One being in real estate equity itself. A lot of it was inherited from the merger of another small REIT which they merged with, or they've also been able to purchase apartment buildings, at a discount from distressed counterparties as well, and then they basically would sell that off and try and capture the difference between discount and market. And then, they've got a couple of small operated businesses that are just of nominal value itself. But effectively we purchased this at about a 40% discount to the NTA. They were projecting that about 60% of the NTA would be in cash by the end of this. So we're pretty much buying at projected, cash value. But along with that, at the price we bought it at, we're projecting double-digit returns, 12 or 13% odd was the running yield that we anticipated, and which they can subsequently confirm. Add that along to a 20% potential unit buyback. That's now in the process of going through shareholder or unit holder approval. And so
I had a quick look at this, Emanuel, and it looks like you bought it at not only a severe discount. They've come out and said, yes, we're confirming the distribution, and then they've said we're actually confirming that we're going to buy back up to 20% of stock because we think it's cheap. We think our own stock is so cheap, and we're going to move to 60% cash or thereabouts in the next few months. So I guess for you, does that kind of, and the dividend yield is obviously pretty attractive right now. Does that for you kind of just confirm that, hey, the downside is cash? That's where I kind of think about this. The downside is cash. I'm going to get a dividend, and then there's potential re-ratings coming out of this.
Yeah, definitely. I mean, from our perspective, if we held on to this opportunity for 12 months and we assumed that the unit price traded back up to the NTA, we were sort of projecting an almost 100% return. It was probably, I think, 70s or 80s percent return that we'd sort of modeled. So it's pretty attractive, considering that through a period of time, this is effectively a cash box, which is an attractive place to be in. But also, also understanding the dynamics of commercial property lending, these big market dislocation, you typically see a large spike up in rates on new facilities at, substantially lower LVRs or rates of leverage against the security property. So, I think that the fundamentals of the industry itself are very positive looking forward. We've sort of heard anecdotally that new facilities are being priced 300 to 600 basis points above past deals. And so we think the group itself and our own fund as well, we're really well placed to capture that extra value that can be sold at this asset class.
I guess if I just think about the risk again before we move on to the next stock, what kind of properties and what kind of properties is the debt or the equity position against?
So it can vary quite substantially. It can be virtually against any sort of real property asset. We ourselves, we have our own methodology and our own bias towards what we consider low risk property assets. For example, construction loans were very popular at one stage over the past couple of years, but construction loans for us haven't really fitted our risk profile in the sense that, with a construction facility, you're carrying a lot of market risk at relatively high leverage because, if you're financing a property through the construction phase, then you're reliant on the end buyers being able to settle
But how about, say, with 360, sorry to jump in again, when you look at
Mhm.
their portfolio, does that match that kind of philosophy to
Mhm.
be, I guess, in your opinion, lower risk, or how do you perceive their portfolio?
I'd probably say they are medium risk
Okay.
in the sense that, they obviously can't offer, full and transparent, uh, reporting, for the sake of commercial confidence. But, we do obviously, we have like, a large, what would you call it, data set of past deals that we've invested in and been offered. So we've got a, data set of about 150 odd deals over the years, that we can sort of refer back to. And we think that their metrics on their loan book are quite reasonable. Can take a downturn of any sort, but a lot of it is in short duration loans, meaning short tenure. So and they're sort of rolling off slowly as time goes on. So we're not expecting any surprises as such. If there are, then we think the loss, any potential losses will be reasonably small, even in a worst case scenario.
Okay, that's great. So that was an Australian real estate investment trust, ASX, ticker code TOT. The next company is one that I find a little bit more controversial, depending on who you ask and I guess who owns it. So I'll let you give us the 101 of Challenger, and I guess some of the events that have happened recently and what you like about it.
Yeah, sure. So Challenger, the leading provider of annuities and guaranteed retirement income solutions in Australia. They've also got quite a significant funds management business as well attached to that. For those who don't know, an annuity is you're effectively selling a guaranteed income stream to a customer in exchange for a lump sum payment. The annuities themselves can be very bespoke, and effectively the provider of the annuity makes money by earning a greater return on the invested capital or the lump sum than the income stream that is paid out to the customer. To us, it's quite a simple model. We think that, given the level of volatility and the government regulations and the Banking Royal Commission, we think that the theme of there being a structural shift towards annuities will be maintained. We're basically expecting that demand for these products will rise over time. But also, looking at the demographics themselves, Australia's got an aging population, and that coupled with government legislation about guaranteed income products going forward, we think that provides quite good tailwind for the business itself. I think one other thing that isn't really considered is, or thought about too much, is the funds management business itself. It has approximately 83 billion funds under management. And the way we think about it is, if you compare it with a fund manager like Magellan, who are obviously very well known in the Australian market, Magellan's funds under management are about 93 billion, and they have a market cap of about 8.5 billion as of today. And that is versus Challenge as a whole. Their market cap is under 3 billion. That's obviously a very simplistic comparison, but it's a little bit of food for thought to maybe consider how much that funds management business is maybe worth in terms of a sum of parts valuation.
I was going to say, how do you value this? But yeah, some of the parts sounds like a reasonable way to do it. In terms of, so if you just take that, I guess that simplistic view, as you said, you have effectively two different assets within this entity that you can value. If you thought about that, you would assume that the life business or the annuities business is actually substantially, it's probably a negative value on the overall business. But if we think about Challenger, that's what kind of everyone thinks about, is that annuities book. And I guess for me personally, that's where I see the risk too. Like, funds management is a very clean, very pure way to run a business. But on the annuity side, there's a lot of mark to market or unrealized gains or losses and those types of things that kind of cloud my judgment. But if you just take it as assets offsetting liabilities for the annuities, How do you think about
Mhm.
the downside of the annuities? What are the risks there associated with guaranteeing those income streams?
Well, the risk is that the provider is unable to provide that income stream. And that's why, it's an APRA-regulated industry. And so Challenger required to have, keep a certain, they have to have a regulatory capital position that supports those income streams that it's sold effectively. And that's determined by APRA. They've already come out a couple of times since this downturn started and reiterated that, yes, we're sort of compliant with, our regulatory capital position and guide along to it. And you can sort of see how their portfolio has evolved, in terms of de-risking in the market. You've seen, they're obviously, a large player in the local market, so it's quite easy to track where they've been selling down equity holdings and de-risking the portfolio. So I think that that was sort of the market's main concern. At the moment, it's trading at about 40% of its 52-week highs. So I think the market has basically assumed the worst. If society does normalize, then would expect that the share price would start to mean as more money starts to come in. Yeah. And one other thing I'd probably say to Challenger is the presence of MS and AD, who are a major Japanese insurer on their registry. So they own 16% of the company, and they've always been touted as a potential acquirer of Challenger, especially given that Challenger do offer foreign currency annuities within the Japanese market themselves. And they do have a strategic agreement with this major shareholder. So I think that's also another very interesting angle, given the large market response and to this situation itself.
Yeah, I guess it's just one of those that I would personally probably need to do some more work on than I have done already. But for me, it's kind of like interest rates falling, risk off. It's effectively balancing the liabilities versus the assets to provide this income and turn a profit. But like you said, the funds management business is growing within it. So it's kind of, there's more than just just a look at the downside for the life book. That's a really interesting one. The last stock that we want to talk about is, I guess you could say, I might call it it's a bit more prickly than the other two. It's had a bit more of a checkered past recently. So it's a lot smaller. So perhaps I'll let you introduce it.
The last one, and as you say, it is quite a speculative pick, and a pick that is very highly leveraged to the economy reopening again. So it's Eclipx Group. The ticker is ECX. And, so this is basically a higher risk turnaround situation for us. So it's involved basically in fleet management and leasing. So clients would be, corporates, government, etc., and, managing their fleets of vehicles. So, as you say, it does have quite a checkered past. Over the past couple of years, it's had, the best way to put it is variable sort of success in a number of ways. Past acquisitions haven't worked out. They've had to take big write-downs in the past on their asset base. But, over the past years or 18 months, they've probably, I think, almost come to the end of the road in terms of their problematic assets, I'd say. They've largely been divested, and a new management team is now in place with appropriate changes in processes. Also, the balance sheet has improved a reasonable amount. A lot of debt has been paid down. There's still probably a bit of work to do from our perspective in the portfolio, and you always have that risk of defaults occurring in the fleet book itself. But I think that made some sort of various assumptions and modeled it all out. And we think that the risk is appropriate for the return, for the potential return. For us ourselves, it is a very small position for us ourselves. Don't get us wrong, but I think the outcome itself is not as binary as the market expects.
I shouldn't cut you off, but I was just going to clarify exactly what it's doing, and with fleet finance, so they get which tend to be sticky customers, corporates, medium to large businesses. They outsource the responsibility for getting cars and vehicles on the road for their employees, and over the duration of the asset's life, they can clip the ticket, and then at the end, hopefully there's some residual value for the vehicle that they can sell into a liquid market. So I guess you can see the risks, or potential risks associated on the downside in terms of being able to resell the cars. Is the residual value what they believed it was when they entered the contract, and financing risk and those types of things. But I guess, and I think this might be where you're going to go, they are quite sticky customers, and it is almost as if the market is pricing in a zero outcome if it's binary, right?
Yeah, well, that's it. And in these leasing sort of businesses, the most upside is basically from customers that choose to just retain the vehicle and just keep paying a monthly lease fee, even though the lease may be up, because that's effectively just pure profit for the leasing provider. And given the economic circumstances, we'd probably expect an uptick in customers like that, notwithstanding probably a higher risk of default in the portfolio overall. But yeah, I guess one other point that is probably worth mentioning is that the company itself has been subject to takeover offers, priced in excess of 900 mil in terms of market value, whereas today it's trading at only 200 mil in market value. So I think that it's evident that this company is quite heavily leveraged to the economic cycle. But if it goes the right way, then I'm sure we'll make quite a lot of money out of it and do really well. If our hypothesis plays out.
Yeah, I guess it's one of those, like you said, it's not a large position. It's one of those that, there are a few things that have to go in your favor. Maybe if you could find 5 or 10 of these in a portfolio, you can afford to, have a small position in each, and maybe a handful of them work out, a handful of them don't. You just have to accept that fate, I guess. But that's kind of how you can, well, at least how I think about weightings and risk-adjusted returns. So it's an interesting one. So that's Eclipx Group, ECX, right? So that's just to recap on this. We've got the three companies. We've got a REIT, which is ASX TOT, Challenger, which many people will know, which is CGF, it's an annuities provider, funds management business, and Eclipx Group, which is ECX. So Emanuel, as we come to the end of this, Datt Capital, you've got the blog, you've got the website. People can follow along there, which I'll provide links to in the show notes. But you're also, or at least I'm hoping you'll come back and pitch us a few more ideas, perhaps next month. We can reassess and I guess take a look at where our two narratives for the coronavirus recovery have started to go. So once again, Emanuel, thanks for joining me on the program. It's always a pleasure, and I look forward to chatting to you again next time.
Yeah, no worries, Owen. It's been a pleasure as always.